Hi, hello friends. Good evening, everyone. Welcome to Investin, India's largest retail investors online conference. I'm Ashok Devanampriya, the CEO of Traders Gurukul and also the host for your today's program. It's a great pleasure to invite every one of you to the most influential stock investor conference of the year 2022. I am sure by the end of this program today, you will have better knowledge on the concept of valuation of different stocks and their sectors. I would like to thank our media partner Money Control Pro, the largest financial portal in India with millions of daily readership on their website, who helped us to reach a wider audience in a short span of time. Let's also thank and appreciate our title sponsor Sher Khan, one of the leading stock brokers in India with millions of investors as their customers. They offer online security brokerage and portfolio management services to institutions, large corporate houses, and individual investors. They have been serving Indian customers from the past 37 years in more than close to about 600 cities across the country. The speaker for today is Mr. Gaurav Chopra from the city of Joy, Kolkata. He is an individual investor in the market for the past 10 years. He specializes in fundamental analysis, valuations, and investing using Elliott waves and macroeconomic themes. He will empower us today with his special topic, valuation of different sectors. Dear Gaurav, on behalf of Traders Gurukul, Money Control Pro, Sher Khan, I extend my warm welcome into this program as an elite speaker. Go ahead, my friend. The stage is yours.
Thank you, Ashok. So in the first part of the presentation, we will see how to value different sectors and industries of the market. Even though the price earning ratio is the most widely used multiple, the primary limitation of the PE ratio is that it cannot be blankly used for all sectors and types of companies. For instance, the P/E ratio cannot be used for unprofitable and early stage companies. Similarly, P/E ratio cannot be used to value cyclical companies, commodity companies, pharma, and banks. So the issue now is, how do we really value such sectors? We shall discuss this in the upcoming slides. We will first look at the banking sector today. Banks and NBFCs should not be valued on the basis of PE multiple, as their earnings are prone to cyclicality. Bank earnings can also be affected by provisioning, write-offs, and other income. So, the best way to value banks is on the basis of adjusted price to book multiple, where we assign a certain multiple to their book value. Now, what price to book multiple we should assign to an individual bank depends upon various factors. If a bank has higher return on assets, higher provisioning coverage ratio, and higher net interest margins, it will get a higher price to book multiple. Similarly, if a bank has lower non-performing assets and lower slippages, it will get a higher multiple and vice versa. These data like ROA, provisioning coverage ratio, net interest margins can always be found out using either the bank website or a research report or the investor presentation which banks usually give at the end of a quarter. Over the past 10 years of my investing journey, I have observed that some banks which have been mentioned on the right side of the slide, like Kotak, Mahindra Bank, HDFC Bank, ICICI, Axis, and SBI, usually trade within a range of a price to book multiple. So, if we can figure out the lower and upper boundaries of the range, we can time our buying and selling decisions in a better manner. Let us consider the example of ICICI Bank over here. An analysis of its price to book range over the past 10-12 years would suggest that a price to book of below 2 can be considered cheap in the case of ICICI Bank. Buying in such a scenario would yield good returns over a medium to long term horizon. On the other hand, a price to book multiple of over 2.5 or over 3 can be considered for booking profits or exiting. Once the stock trades over 2.5x or 3x book, I have observed that future returns can be poor or even negative. In the next slide, we shall now discuss how to value pharma companies. Now, pharma is another sector which should not be valued on the basis of price to earning multiple. So we should now understand how a pharma company generally works. First, they start constructing a new medicine plant. Then that goes for approval with various authorities. Then they develop a drug. Then that goes for approval. Then that is launched in the market. So pharma companies and their business cycle usually have a long gestation period. That is why I do not wish to value pharma companies on a price to earning basis. Rather, pharma companies should be valued using supply side economics, which involves studying their underlying drug portfolio, newer drug approvals, how many drug approvals have they filed for, which are pending for approval, how much capex are they doing presently, how much are they spending on their medicine plants, and the resultant cash flows being generated. So pharma companies generally should be valued using two ratios: enterprise value divided by sales and enterprise value divided by cash flow from operations. Now the issue is, what multiple do we give if we are valuing using EV sales? While assigning a multiple, one must take note that if a pharma company has higher drug approvals, higher margins, and higher cash flows, such a situation would generally lead to a higher multiple being assigned. Over the past years, what I have observed is that smaller pharma companies, like for an example, Newland Labs, generally trade in an EV sales range of 1 to 4, where 1 and 2 can be considered a cheap buy, and if the current EV sales ratio has reached 3 or 4, that can be considered expensive and an investor can look to exit. On the other hand, larger and diverse pharma companies like Sun Pharma generally trade in a EV sales range of around 3 to 6 or sometimes 3 to 7 also. If we see that the current EV sales is below 4, maybe 2, 3 or 4, then that can be considered a cheap buy. Conversely, if the current EV sales has gone above 6, then it can be considered expensive and one should look to book profits. I will illustrate this in the next slide. In this way, if you look at the graph, one can decide when to buy and when to sell, when the stock is expensive and when the stock is cheap. So an investor can take better and informed decisions in this way. In the next slide, we will study commodity companies. So commodity sector, which includes metals, oil and gas, is another industry where one should avoid looking at the price to earning multiple. So commodity companies are best valued on a price to book multiple rather than a PE multiple, which helps us in avoiding fluctuations in earnings. So we all know that commodity companies derive earnings from the underlying commodity which they sell, and commodities are cyclical in nature. Prices go down a lot, similarly they come up a lot, like what we are seeing in the present situation. So if you consider the current year or the next year price to earnings, we do not know how much it will fluctuate in the coming years. So it is better avoided. So the P ratio is actually better avoided if we are trying to value commodity companies. If an investor were to look at the earnings or ROE at a cyclical low point or a cyclical high point, it would give a misleading picture. So now, how do we buy and how do we sell commodity companies? Commodity companies are always bought asset cheap and always sold earnings cheap. So I'll explain what do I mean by this. Commodity companies are usually bought when their price to book is below 0.5x. On the other hand, the best time to sell is actually when they are trading earnings cheap. That is when the temporary supernormal earnings make them optically look cheap on a PE basis. In commodity companies, one should not make the mistake of applying peak margins to peak multiples at the peak of the cycle. So I'll explain this with the help of an example. Let us consider the case of Tata Steel BSL. So this is actually a subsidiary of Tata Steel, and the erstwhile name of this company was Bhushan Steel Limited, and Tata's bought this in an auction from the NCLT. In July 2020, when I was analyzing this stock, I found that it was trading quite cheap and its book value was just 0.15. At that time, I bought it, and later on the price went up to somewhere around 100 or that range. I exited later on when the price was around 90 and the price to book also went beyond 0.5x. At that time, what I observed was the company was now generating very high profits, very high cash flows. If I tried to calculate the P at that time, the P would somewhere be around 5, 6, or maybe 7. So this is actually not the time to buy. If someone would be looking at the P multiple, he or she would decide that भाई ये तो बहुत सस्ता है, 5-6 का P तो है, आराम से ले लो. But this is actually the time to sell or at least book partial profits and wait for a correction. So next we'll consider how to value hotel companies. So this is another sector where one should avoid looking at the underlying earnings or the PE multiple. Hotel companies are best valued on a EV per room basis. So generally for a 5-star property, the EV per room is 1.5 CR. For a 4-star property, it is 1.25 CR. And for 3-star, it is 1 CR. I will try to explain this using an example of Indian hotels in the next slide. So how did I value this? I first went to the website of Indian hotels and noted down its various brands, their star rating, and the number of rooms in each category. By using the EV per room technique, which I mentioned in the previous slide, I came up with a target enterprise value of approx 36,515 crores. I then subtracted the debt and added value of various joint ventures of Indian hotels and came up with a target market cap of 33,515 crores. So according to me, this is a fair value of Indian hotels. Presently, the market cap of Indian hotels is approximately 29,000 crores. So we can see that there is some upside in the stock as of now. So the next sector we will now consider is the IT sector. This is one sector which can be valued easily on a price to earning basis. However, the question is what P multiple to assign. So generally over the past 10 years, I have observed that large cap IT companies like TCS, Infosys trade around 20 to 30x earnings. Tech Mahindra, HCL Tech trade around 15 to 25x earnings. Now, if a company has higher dollar revenue growth and is generating higher EBIT margins, that would call for a higher multiple and vice versa. Similarly, if the company has a lower employee attrition level, it can retain employees for long and gets revenue from a diverse set of clients who are present all across the world, it would get a higher multiple. So this is why I explained that TCS and Infosys generally get a higher multiple because their growth rate is higher, their EBIT margins are around 25%, and they consistently grow around 10-12% every year. I'll explain this with the help of an example in the next slide. So this is an interesting example, Explio Solutions. This is an IT company owned by the Europe-based Explio Group. In July 2020, I was analyzing this stock and found that the stock was trading around 270 and its P ratio was just 7. The P ratio of this company, whereas used to be around 20 or 25 just 3-4 years back, I found that this company was trading exceptionally cheap. It was cash rich and was growing around 10% a year. This is when I bought the stock around 270. Over the next 1.5 years, due to better earnings and re-rating of the PE multiple, the stock hit around 1500, where